Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Scott Kefer. He's a Senior Portfolio Strategist over at VictoryShares. We're going to take a look at dividend growth strategies. Scott, welcome to Market Site. And in this low interest rate environment, everyone's looking for yield, high-paying dividends. What exactly is a dividend growth strategy?
Absolutely. Well, thank you for having me,
You're
Jill.
welcome.
So dividend growth strategies try to identify companies that are able to grow their dividend year over year. Oftentimes we think about what kind of a negative signal it sends when a company misses or stops paying their dividend, but there's a real positive signal that's sent when a company is able to increase their dividend. So dividend growers tend to be companies with exceptional quality and really some enviable traits. They tend to be companies that have strong profitability and cash generation, strong balance sheets. They tend to be companies with great stability, and importantly, they tend to be management teams with good outlooks for their business and real shareholder-friendly policies. So our work actually shows that dividend growers, when you look historically and you compare them to companies that don't pay a dividend or companies that pay a dividend but don't raise their dividend, dividend growers tend to outperform and tend to do so with less volatility. And obviously companies that cut their dividend tend to be the worst performers and the most volatile stocks.
All right, and these are all the factors that you look for when making your selections within these companies.
Yeah, that's actually a really interesting point, and I think where our Dividend Accelerator Index is differentiated from a lot of our peers. Many of the peers in the space sort of take a naive approach, simply screening the universe for companies that have long histories of paying their dividends. But it's not only important to have a track record of growing your dividend, but it's also important to assess a company's financial condition to continue to pay that dividend. Mm-hmm. So for Dividend Accelerator, that index, what we do to differentiate and I think solve for that is we apply a rules-based systematic approach where we screen for many of those characteristics you mentioned. So things like profitability metrics like ROE and stability metrics and balance sheet metrics. And we use that information to assign probabilities of their ability to grow their dividend in the out years. One of the things that also differentiates us is that unlike our peers who want long histories of paying the dividends or growing their dividends, we will apply those metrics to companies with a 5-year history. So we're trying to capture those dividend growers earlier in their life cycle. And one of the things we're most proud of is since the index was launched, it's had a 100% hit rate of identifying accurately companies that do in fact raise their dividends 12 months out.
There is a difference between growing dividends and high dividends. Absolutely. There's a reason why sometimes your dividend is high.
Exactly right. So first and foremost, it's a great question, and there's room for both in an investor's portfolio. Mm. The big difference is, as I said earlier, a dividend grower tends to expose the investor to high-quality companies. Yield strategies tend to bring more of a value bias or a value factor exposure to an investor. Like you said, sometimes the yield could be high for a reason. And one of the things you have to be aware of is that with a high yield strategy or a high dividend strategy, you're probably going to be a little bit more interest rate sensitive. But you also have to be careful of those accidental yielders that you referred to, those companies that the dividend yield is high because something might fundamentally have deteriorated, causing the stock price to fall. And obviously the worst thing a yield-focused investor wants to do is put their principal at risk. So you have to be mindful of that. A dividend grower, on the other hand, really seeks to deliver a total return solution where the yield is attractive and maybe not quite as high as a high yield strategy. But with that attractive yield and those quality metrics, you get the combination of attractive yield plus principal, and you get a real potential for a total return type solution.
And to wrap up here, let's take a look at where we are in the market cycle right now. Historically low interest rates, the averages as we're sitting here on December 17th are at all-time highs. Where in an overall portfolio would this kind of strategy fit?
Great, another great question. So it's absolutely a component and a building block of an investor's core type allocation. Fits in there very well. I think too, with the duration of this market expansion, investors are very mindful of being exposed to strategies that give them exposure to higher quality companies, and companies like our work shows that have historically delivered lower volatility. So that combination is a real good fit within a core allocation in this current market environment.
All right, Scott, thanks so much for joining us at Market Site. And thank you for joining us on Trade Talks.
Carefully consider the VictoryShares ETF's investment objectives, risks, fees, and expenses before investing. Visit VictorySharesLiterature.com for a prospectus or summary prospectus, which contains this and other important information about the funds. Read the prospectus carefully before investing. Investing involves risk, including the potential loss of principal.